if you read an entire book of investment advice or financial advice, you don't want someone to end the book saying, I don't have a solution for 98% of your problem, but here's an insurance policy. 1 or 2% is like buying an insurance policy, but 20, 30, 40%, 50%, 75% is like solving the problem.
In a discussion with Guy Adami and Dan Nathan on the On the Tape podcast, Michael Saylor, executive chairman of MicroStrategy, provides a comprehensive overview of his views on Bitcoin, MicroStrategy's approach, and the evolving investment landscape. This summary aims to distill Saylor's insights into an educative format, offering investors a structured understanding of his perspectives on Bitcoin as an investment asset, MicroStrategy's approach, and the intersection of AI and finance. A cornerstone of MicroStrategy's strategy is the acquisition and holding of Bitcoin as its primary treasury reserve asset. Saylor explains the rationale behind this approach. Holding Bitcoin is seen as a way to optimize the company's balance sheet, protecting it from currency devaluation and inflationary pressures. The company views Bitcoin as a long-term investment, aligning with its belief in the asset's potential for significant appreciation. Saylor contends that this strategy enhances shareholder value by positioning MicroStrategy as a leading player in the Bitcoin ecosystem. Before we delve into the video, if you want the latest crypto news, market updates, and expert insights from the top minds in the industry, be sure to hit that subscribe button and turn on notifications. Stay informed, stay ahead, and never miss an opportunity in this ever-changing world of the financial market. Thank you for subscribing to our channel.
The whole idea of diversification makes sense when you don't know the answer, but you don't want to make a mistake. But I think in the field of engineering and in many fields in life, it's like when your kid is a good basketball player, you don't say, I think you should split your time between archery and jogging and swimming and basketball and football and hockey and 16 other things just in case. You tell them to focus on basketball, and you build the plane out of aluminum, and you don't diversify the steel beam into clay and bronze and balsa wood, right? If there's an answer, there's an answer, and you just tell someone the answer. When you don't know the answer, you're like, yeah, we'll go to Vegas and gamble and pick anything, but don't bet more than 2% of your money, right? Don't. So my point really is, there's a disconnect between giving someone a piece of advice to make their life better and then saying, but I 98% don't believe in it. The middle of 2020, we're running a $500 million business with $500 million in cash, generating $75 million in cash flow a year, growing 0 to 5%, competing against Microsoft. Lockdowns hit. Our stock has 0 options. $2 million of liquidity a day. The options are worthless. The stock is worthless. We have no investor interest. We're stuck in a competitive trap. There's no way to crawl out of the competitive trap. We've got $500 million in cash generating 4% interest, and all of a sudden Jerome Powell cranks that down to 0% interest. And then everybody's locked in their home, and I'm staring at, and then I watch all the Magnificent Seven stocks double. And then you realize that if you're sitting there, all your capital is going to be siphoned off by the Magnificent Seven. All your human capital is going to be siphoned off by the Magnificent Seven, right? Even if you have a good product, it won't be a good product in 5 years once all your engineers quit. And so we're kind of stuck in a trap. So at that point, you have 3 choices. You have a fast death, just sell the company. And a lot of people do. 99%. I had 100 competitors, guys. 99 of them, or actually all 100 of them, sold themselves. Right? You just exit. Or it's slow death. I have my $500 million. I'm just going to start to pay all my employees massive cash bonuses to not quit, retention bonuses. But you're just going to go through the cash at some point. You're not going to be able to get out of your hole. You're going to linger on as a zombie. Or you take a risk. And the risk is a transformational acquisition. It's like, when you buy VMware. It's like, can you buy a company that's growing 20 to 40% a year, that's a monster world beater company, and can you buy it for cash or buy it for stock, and maybe you give a new lease on life? And so I looked at, option one, I looked at option two, and I thought, well, is there some monster company we can buy with our $500 million in cash? Because right now it's a liability. And obviously I couldn't find one, but then I looked at Bitcoin and I thought, Bitcoin looks like Facebook for money. It looks like the global monetary network. It looks like the dominant. It looks like the Google or the Facebook. And so I'm like, what's the big tech monster network for money? And Bitcoin looked like that for me. So I thought, hey, maybe I can do a $500 million acquisition. I buy 500 million of Bitcoin. What if you could buy a company growing 60% a year at 1x revenue with cash that you don't need? That was the idea. And it was kind of out of frustration and desperation, but it was a strategic Hail Mary, because your choice is just sell the company, give up. And the company would have been sold for $6 a share in enterprise value. Okay, $6 a share after 30 years of life. So we do that. We get to the 500 million, Bitcoin rallies, the stock doubles, the stock triples. Now we just have an opportunistic run. We discover the convertible bond market, and they want to give us $650 million in cash pretty much for free. If I came to you and said, I'll give you $650 million, it's 75 basis points, go invest in something. Can you come up with an idea for something to invest in that yields more than 1%? Probably. If you can't, right, you're not in business, right? Probably you can. So we did that, and Bitcoin rallied again, and all of a sudden we were able to raise $1 billion for zero. Okay. And then we realized, well, we might as well take another 500 million, and we took a $500 million loan at 6%, and we thought, well, Bitcoin's going up 60, we'll borrow at 6, we'll loan at 60, we'll capture 54. And it moved around, and then at some point, some banker called me and said, you can do this ATM where you can actually sell equity in the market. I said, you're kidding me, really? That's possible? And actually, the greatest innovation of the past 30 years, guys, in the capital markets is the ATM shelf registration of equity, because it allows an issuer to sell shares pari passu to an investor. You're basically on the same footing as anybody else. It's a fair thing. And for my entire career, if we wanted to sell $100 million of equity, our stock would get hammered down 20%. And so it felt pretty good to not get hammered 20% and be able to sell into the market whenever you want. And so now we hit upon this new stage where we realize we have a commodity that returns more than the S&P index that we can buy selling our stock. So if you're an investor and I give you a return higher than the S&P, how much capital are you going to give me? Infinite. So we started doing that. We sold $1 billion of that. And the short of it is we went from a $500 million investment to $10 billion of capital raise, and the stock, went up by a factor of 10 or 20. And then we got to 2024, and 2024 was by the way, I skipped the crypto winter where everything crashes from 66,000 to 16,000, but this is a half-hour podcast. So I'll just say it was a roller coaster. We went up to 66, down to 40, up to 66, down to 16, back. But, and that's all very colorful. But the real point is we're buying Bitcoin with equity, with debt. We're refinancing the debt. We're at all points, generally, we're doing it in an accretive way. And we get to 2024, and then we discovered the value of volatility. I mean, really understand it. Because in January of 2024, Bitcoin isn't an asset class, and the second week, the SEC approves those ETFs.
Saylor is a proponent of long-term investing, particularly in the context of Bitcoin. He stresses the importance of patience and a long-term perspective when investing in Bitcoin, as its price can be volatile in the short term. Investors should focus on the long-term potential of Bitcoin and avoid being swayed by short-term price fluctuations. Saylor suggests using a dollar-cost averaging strategy to gradually accumulate Bitcoin over time, reducing the impact of price volatility.
In conclusion, Michael Saylor's insights offer a valuable perspective for investors navigating the evolving financial landscape. His strong advocacy for Bitcoin as a transformative asset, coupled with MicroStrategy's strategic approach, provides a compelling case for considering Bitcoin as a core component of a diversified investment portfolio. While acknowledging the risks, Saylor's long-term vision and emphasis on the potential of Bitcoin to become a global financial standard underscore the importance of understanding its role in the future of finance.